If you've been keeping an eye on the housing market, you know that spring is supposed to be the busy season. But this year just feels different, right? Let's break down exactly why the spring market seems to be stuck, just kind of hovering. And that feeling is perfectly captured by this quote from Lisa Sturtevant, the chief economist at Bright MLS. She said, "The spring housing market is in a holding pattern." I mean, that's such a powerful image, right? Think about it. Planes just circling the airport waiting for the all clear to land. Well, that's pretty much our housing market right now. Okay, but what does a holding pattern actually mean for you? I mean, if you're trying to buy a house or maybe sell one, or heck, even if you're just trying to make sense of the economy, that's the big question we're going to dig into. All right, so first up, market in a holding pattern. Let's really paint a picture of what this looks like on the ground. So what we're basically seeing is, well, a massive pause. Everybody's just hitting the brakes. Instead of that usual spring frenzy, you've got both buyers and sellers kind of stepping back, waiting and watching. And let me tell you, that kind of hesitation is really not normal for what's supposed to be the most energetic time of year in real estate. So the big question is, why? What's causing this big stall? Well, the main culprit, the biggest hurdle in the market right now, is, you guessed it, mortgage rates. Okay, get ready for this. According to Freddie Mac, the average 30-year fixed-rate mortgage just hit 6.46%. Now, that number alone is one thing, but it's the story behind the number that really matters. It's not just high, it's the highest weekly average we've seen in 7 whole months. And this chart really puts into perspective just how fast things have changed. I mean, think back to February. It feels like yesterday, right? Rates actually dipped below 6% for a hot minute, and a lot of people got their hopes up. And now, bam, we're nearly half a point higher. Talk about whiplash. And the thing is, this wasn't just some sudden one-time shock. No way. As you can see here, it's been a slow, steady, relentless climb. 5 consecutive weeks of increases. It's that constant upward pressure that's really starting to mess with the market psychology. Okay, enough with the percentages. Let's talk about what this really means, for your wallet. How does this rate jump actually hit your monthly budget? Well, compared to just 4 weeks ago when rates were hovering around 6%, that jump to 6.46% adds about $115 to the average monthly mortgage payment. Now, that's a real, tangible hit to affordability. It's the kind of number that makes a potential buyer stop and think twice, for sure. So now let's look at the ripple effect. How is this financial pressure directly impacting the actual people in the market? The buyers and the sellers. And what's fascinating is that this reaction is happening on both sides of the aisle. For buyers, applications are slowing way down, and their confidence is definitely shaken by all the economic uncertainty. But at the exact same time, sellers are also hitting pause, which means fewer new homes are even coming onto the market. And we've got some hard numbers to back this up. The Mortgage Bankers Association, get this, they reported that overall mortgage applications fell over 10% in a single week. And when you look specifically at applications to purchase a home, those were down 3%. It's like their chief economist said, these shocks from rates and the economy are just hitting buyer confidence hard. Okay, so before we dive into what the sellers are doing, let's just quickly get on the same page with 2 terms. You've got active listings, that's basically everything for sale right now, and then you have new listings. Those are just the homes that popped up on the market very recently. It's a small difference, but it's super important for what we're about to see. Now here's where things get really interesting. Depending on who you ask, you get a slightly different story on new listings. So you have Compass reporting a 2% drop compared to last year, which suggests sellers are pulling back. But then you have Redfin, and they're seeing a small increase of 1.7%. This just goes to show you how complex and, frankly, confusing the market is right now. Even the data is in a bit of a tug-of-war. Which, of course, leads us all to the million-dollar question: what happens next? Where do we go from here? Let's take a look at what the experts are predicting. So according to Zillow's senior economist, it seems like we're standing at a fork in the road. Path number 1, if rates dip soon, we could see a huge rush of pent-up demand. All those people in the holding pattern suddenly land, creating a sort of catch-up spring season. But path number 2, if these higher rates stick around for a while, all those deals could get delayed until next year, basically repeating the slow motion pattern we've already seen. So what's the big takeaway from all this? Honestly, I think this piece of advice from Hannah Jones at Realtor.com just hits the nail on the head. Her advice? Stay nimble. The market is just so volatile right now, and the people who are going to come out on top are the ones who can act fast the second a little window of opportunity, like a quick dip in rates, opens up. And that really leaves us with one final question to chew on. In a market like this, a true holding pattern, where everything seems to hinge on unpredictable rate changes and the next piece of economic news, is finding an opportunity more about having a brilliant strategy, or is it just about plain old luck, being in the right place at the right time? It's definitely something to think about.